Welcome to Stock Odds, Odds and Ends podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything?
Not too bad. I need a long weekend. I got still getting caught up on stuff. Can you give me a long weekend next time?
We need 5-day weekends and 2-day work weeks.
That's what I need, a 5-day weekend. All right. So we had a busy week. We ended an expiration, right? And we actually ended what is the best performing week of February. So not to say that things couldn't change here and we might have some robustness at the end of the month, but we kind of need to address why, we ended on, it came off the bottom a little bit there on Friday, but why did we have a down day on Thursday and some follow through on Friday? What was going on here? So we need to address that. So first I'll run through just some Friday's performance here. So Microsoft was down 1.56% on Friday, Apple down 0.75%, Nvidia down 2.79%. Tesla was up 3.1%. Meta was up just slightly, Google was down. We had some movement in the healthcare on the positive side, Johnson & Johnson. So a down market to some degree, not huge, but Johnson & Johnson and Merck and Pfizer were all up. UNH was up 2.41 for healthcare plans. And the reddest sector of all was the energy. Exxon was down 3.85%, Conoco down 3.91%. This is just Friday's performance, one day. So oil was just getting slaughtered here. The consumer staples, Walmart was up or 1.5%, Coke up 1.52%, Procter & Gamble up 2%, 2.09%, and tobacco, Philip Morris was up 1.51%, and Altria up as well. So it really seemed to be defensive on Friday, even though things lifted off the bottom. Utilities were okay. Industrials were mixed, but not too bad, mostly green. Financials were mixed. And so let's look at the week. 1 week performance. Tesla came in at a 5.8% for the week. Again, the same kind of splattering. Energy, the worst. Exxon down 6.62% for the week. Conoco down 9.51%. EOG Resources down 11.72%. So just a bloodbath in the energy department. Where consumer defensive, home improvement and auto parts, travel, industrials, all doing pretty good. Utilities and healthcare a bit mixed. Overall, healthcare didn't do as well for the week as it did on Friday. So that's the lay of the land there. Looking at the sectors. So again, for the week, consumer cyclical up 1.71, consumer defensive up 1.38, industrials up 0.89, utilities up 0.75, communications up 0.62. Healthcare almost flat, technology down minus 0.26, financials down minus 0.3, basic materials down minus 0.48. Now we had the dollar up a bit for the week, so that probably plays into the basic materials down. Real estate minus 0.89 and energy down minus 5 for the week. Just killed it. So going into the futures here, we're seeing that the US dollar, it's actually fascinating I would recommend doing this just to look at the monthly charts as well. because it gives you some pretty good perspective, and the support and resistance stands out so much better too. So the US dollar, for example, is up this month, and it had pulled back into what I think was a reasonable support level. So right now, it's still looking like it has a little bit of an appetite to continue up, probably on the back of some of the Fed speak. We'll talk about that in a minute. So it's up 0.21 right now, the dollar. And looking at the Dow Jones, it's down 0.38 right now. S&P's down 0.43. NASDAQ's down 0.38. Russell's down 0.57. And the VIX is up 2.36%. So we're seeing a little bit of a move. Now that support level really held there. That was in the 18.5 area on the VIX, and we're back up to 21.75. So lots of blue sky above us. I mean, there are numbers all the way through, but lots of blue sky. It kind of seems to have held that bottom, and it's lifting off of that. So that could be of note. In the bond department, bonds are down 0.27 now. The last month, or this month so far, it's been sliding, pretty orderly. And again, that's bonds heading down, yields heading up, and again related to the policy of our central bankers. And let's see, on the metal side, gold. You got to put that in the monthly. You can see just the clear pullback that we had since the end of January. We finished strong. November, December, and January were robust. And then February, we've pulled back a bit. So we've erased the move that we had in January on gold. Copper, more recession orientated, it's up 1.41% right now. It's doing better than gold, so it's not as impacted by the dollar. And it's also more related to economic conditions, which have still, we've got this dichotomy here of good economic news, and yet we're not done raising interest rates to fight inflation. So it's like good news is bad news, and bad news is good news, right? Okay, over to you, Dave, and then we'll circle back to talk a little bit more about what the drivers are here. So go ahead.
In the StockOdds seasonality almanac, we're getting close to the last 5 days of the month.
It starts on Wednesday, doesn't it?
Yeah, because this is a pretty short month. It feels like 19 trading days in February.
Yeah, so we got tomorrow. Tomorrow's trading day is kind of a no man's land, and then all of a sudden we hit the 5-day seasonality window.
Yeah.
Right.
So some of the ETFs expected to be weak in that window are gold, jets, some of the airlines, some of the house builders, and some of the banks, KRE and KWeb. And then if you look at the last 3 days of the month, very similar as well. Gold is weak again, silver, utilities, energy, staples. So it's like a lot of the materials and metals are weak. And the ones that are stronger are actually the more risk-on stuff. ARK, XBI, which is biotech, retail, XRT, the SOX, which is chips. So a little bit more risk-on in that last relative to the symbols that are weaker, but still it's pretty soft. The final few days of this month are expected to be down minus 0.68% for the last 3 days of the month, and minus 1.62% for the spider for the last 5 days of the month. So all the bang really is the mid-month seasonality and options expiration. And the end of the month is a lot softer, with the last trading day of the month also down minus 0.47%. So that's the backdrop there. And then we do have some earnings of note. Tuesday at Home Depot, that could give us some color as to how the consumer is spending or pulling back. We have Walmart also, again, focus on the consumer. And there's many other symbols to Caesars Entertainment. We've got Twinkies, right? Hostess Brands. There's still a lot of earnings in the backdrop there, so you have to cross-check your symbols versus the list of earnings. And then there are some semiconductor stocks, such as NVIDIA. They have reports too, I think. Baidu, eBay, Etsy. So some of the NASDAQ ones are still reporting. And then Thursday, Carvana, Dish Network, Domino's, EOG, big variety of symbols on. And then Friday as well, we have a couple there. So there are some earnings in the backdrop. Now, economic reports. Tuesday, we have S&P Services PMI. Wednesday's key moment. We have the FOMC minutes, 2 p.m. Eastern. So that could be a market mover. Thursday, initial jobless claims and GDP, so health of the economy. And then Friday, consumer spending, core PCE, new home sales. So a lot of revolving around the consumer's health, even the Home Depot and Walmart. So we'll see how well the consumer is holding up, given all the inflationary pressures and drop in savings rates and increase in credit cards and all those kinds of themes. So that's it for the macro there.
Okay. Well, back to this thing that really changed this week, heading into Thursday and Friday. And really it was some of the Fed speakers, because we had the Cleveland Fed president, Master. Now, he's not a voter, she was advocating for a 50 basis point rate hike. That was back for the February one. Of course, we only got 25. We had Fed President Bullard. He's also a non-voter, but he wouldn't rule out supporting a 50 basis point rate hike in the March FOMC meeting. And Fed Governor Bowman, which is a voter, said that rate hikes should continue until a lot more progress has been made on inflation. So that backdrop kind of sent things down, because we kind of gave the market gave the CPI numbers a bit of a free pass, right? And the PPI was on Thursday, but some of this, Fed speak really contributed to the weaknesses. So that's kind of what happened there. And, I don't know if this Larry Summers warning here. So he was the former Treasury Secretary, right? And what he's saying is that, and that was published today. So he warns the U.S. economy is headed for a collision as Fed rate hikes aren't working. So does that mean the Fed is going to have to really get even more aggressive with hikes, right? That's what Fed Governor Bowman, which is a voter, was saying, that rate hikes should continue until a lot more progress has been made on inflation. So the way they're looking at it is that, the real progress hasn't been completed, hasn't been made yet, and yet the markets was looking forward, thinking what the Fed is doing is working, and we're going to get this behind us soon enough. So this is the tension. I think the market came up pretty fast in January. Now, we had short covering, we had tax loss rebuying, but here's the year to date so far. Dow Jones is up 2%, NASDAQ's up 12.6%, S&P's up 6.2%, and the Russell's up 10.5%. So, we had and that's pretty good for, what we've been, not even 7 weeks, right?
Mm-hmm.
Not even a full 7 weeks.
Good returns for a full year.
Yeah, and so I think maybe the market got a bit ahead of itself. There was some enthusiasm. I know from our baskets perspective, it seemed that our short side was the one giving us some trouble in January. Wouldn't you agree?
Yeah, it seems like people were just overpaying at the open just to get involved, and it just.
And why I think the shorts, had some trouble is because if you think about all of 2022, all that data, the market was rallying a bit and it would sell off and it would rally a little bit and sell off and kept selling off. So we were making lower lows and lower highs. And so the data, started to get trained based on that action where, buying the dip wasn't working, but selling the rallies certainly was. And then you roll into January and we're still going back 2,000 days, but you got that latest sample in there as well. And so it was putting a damper on, I would say, on how things were prior to last year. So our shorts it was doing the same thing that we were doing before. So it's like it should have worked out fine. But with the rally and the, sort of fear of missing out was coming into it. We even had some meme stocks and things like that started to be in focus again by traders. Now, granted, it's been pretty short-lived. Like, the meme thing even died down already too. But I just think that those stocks that were coming up in our list the same approach would have been fine in December, right? Would have been fine in March or April of last year, but January with that tax loss rebuying and that fear of missing out just felt like our shorts were getting run over a little bit. So I mean, you're still hedged to a large degree, but you're just not getting the returns that you want, right? But I think things are starting to get back on track. It just takes a little bit of time for statistics to adjust because you're adding constantly new data to the previous data. So it just takes a little bit to adjust, but I think they'll get back on track. So, what else can we add to this whole thing here?
There's still global risk. I mean, Ukraine, it sounds like Biden's doubling down. Stick with supporting Ukraine until infinity.
Well, I mean, it is a double down. I mean, it is really a NATO against Russia. I mean, it's even become more than just a proxy war if we're going to be, continuously sending them money and then tanks and everything. But it's definitely, I mean, I can't see Putin giving up either and saying, oh, okay, well, let's call a truce. Can't see that. Can't see Zelensky saying, well, sure, we'll split the country in half and give him half of it. I can't see Biden stopping. Not a good situation. Add to that the Middle East stuff and more earthquakes in Turkey today, and that's horrible. So we got a shortened week. So just reminder about that. We still have some news coming out. We're not done with news yet. Economic reports. And then we finish the month on the 28th, Tuesday. So it's not a leap year, right? So we don't get to leap ahead this year, but just a reminder that companies do report. There's still companies that do report, like, warnings ahead of earnings season, give some guidance things. Not as many as used to, but there's still some of that. After we finish earnings season, then we usually go into dividend season. So be mindful of that. overnight, if you're short stocks, you do pay a dividend or collect a dividend. There is some dividend drift that can happen ahead of dividends as well, so check for that. Okay, well, I guess that pretty much covers it. And we aren't going to have a meeting on the 20, so we won't do a wrap up like this on the 26th. We'll just skip a week, okay?
All right.
Mind. Possibly, yeah. I mean, I'll check in with you, Dave, but I may not be able to do that night. So I'll check back with you, but the 26th we may not have one. Okay.
All right.
Catch
Good
you
luck.
later, Gator.
Thanks. Bye-bye.